Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know, first, Zions Bancorporation's $1 billion market value plunge over a $60 million loan loss sparks fears of a new US regional banking crisis. So we'll discuss why this isolated fraud case is reigniting systemic fears and what it means for credit availability and future Federal Reserve policy. Second, S&P 500's 13% rally defies stark warnings from the Bank of England as stretch valuations test the market's faith in AI. We'll analyse why the traditional Fed put may not rescue markets this time and how stubborn inflation creates a major vulnerability for investors. Third, Trump's proposed $150 price cap on Ozempic sends Eli Lilly and Novo Nordisk shares tumbling, shaking the weight loss drug market. We'll explore how this political move not only threatens pharma giants, but could also deliver a one-off shock to inflation data, complicating the Fed's job. A $60 million loan problem just vaporized $1 billion of a bank's market value in a single day. We've talked about how fragile regional banks remain post-2023 and how one headline can trigger a sell-first reflex. Today is that playbook in real time. That's the story rocking Zions Bancorporation, which saw its shares plunge 13% after it disclosed that $60 million in loans were likely unrecoverable. The fallout didn't stop there. The news sent shockwaves through the entire regional banking sector and helped knock the Dow Jones Industrial Average down 300 points as fears mounted over the health of bank lending. We've seen this kind of broad reaction before when the SPDR Regional Bank Index swooned on credit. Scares one name stumbles and the whole cohort pays. However, if you zoom out, you'll see another layer of strategy at play. The market's reaction is likely a classic case of shoot first, ask questions later. That impulse is strongest when the private credit backdrop is opaque and investors don't yet know where the bodies are buried. The key here is to distinguish between an isolated company-specific fraud and a widespread systemic credit crisis. Actually, Zions' own recent financial reports showed stable performance with a 9% increase in net interest income. This suggests the problem is more likely an idiosyncratic failure of due diligence on a specific old loan, not a new sign that the entire banking system is cracking. Whether this is a contained event or the start of a new wave of bank stress will determine everything from credit availability to future Federal Reserve policy. At the center of the storm is a lawsuit filed by Zions' subsidiary, California Bank and Trust. It alleges what it calls a sweeping betrayal of trust by sophisticated financial borrowers. The bank claims two fund managers, Andrew Stupin and Gerald Marshall of the Cantor Group, abused its confidence and manipulated loan structures for their own enrichment. We previously analysed the industry's vulnerability to sophisticated counterparties in the shadow banking world. Now those concerns have landed squarely on Zion's doorstep. So the thing is, the bank provided the financing believing it had first priority interest on the collateral. But the lawsuit claims the borrowers secretly subordinated the bank's position, effectively pushing it to the back of the line. The collateral properties were then allegedly transferred or foreclosed on, rendering them irretrievably lost to the bank. This incident might be a leading indicator of a hidden problem called zombie loans. These are complex loans made during the era of near-zero interest rates, where convoluted structures can hide the true value or security of the collateral. They lie dormant on the books, looking fine, until a default or investigation suddenly reveals the truth. Continuing our last discussion about stress, leaking out of opaque private credit into the banking system, and after early warning signs we flagged in areas like autos and hedge fund exposures. This is another reminder that legacy deals from a different rate regime can still bite. This suggests a hidden tail of credit problems from a prior economic cycle could now be coming back to haunt the market, potentially forcing a broad tightening of lending standards. And who replaced the bank as the new senior lender with first claim to the assets? According to the suit, it was the fund managers themselves or their affiliates. The lawsuit puts it bluntly, in effect, CB&T's losses became defendants' gains. Here's where it gets interesting. Zions didn't uncover this on its own. It only launched an investigation after a completely different bank, Western Alliance, filed its own fraud lawsuit against the very same Cantor fund managers. Western Alliance's case was an early flare. Now we're seeing how one bank's discovery can ripple into another's books. The fact that this fraud went undiscovered for years and was only exposed by another company's actions, points to significant gaps in ongoing loan monitoring and collateral tracking at the bank. According to regulators like the US, Office of the Comptroller of the Currency, or OCC, banks have a core responsibility to implement policies and control systems to manage fraud risk. This incident exposes a potential failure in that exact process. Regulators were laser focused on interest rate risk after 2023. Today's twist is a reminder that old-fashioned operational failures can still be the spark for contagion. This could trigger a costly sector-wide investment in risk management technology and personnel, putting pressure on bank profitability and possibly making them less willing to provide complex loans in the future. The $60 million charge-off is a major blow, but the real damage is the $1 billion question it forces onto the market. If this could happen at Zions, what other hidden risks are lurking on the books of regional banks across the country? This is the moment to separate a one-off cockroach from an infestation. So, what's next? In the near term, we can expect a pullback in bank financing for certain types of clients, especially private distressed debt funds. Bank lending to these non-bank financial institutions has doubled to $1 trillion in recent years. After a shock like this, banks will become much more cautious. This will likely push these funds toward more expensive non-bank private credit lenders. This raises the cost of capital for resolving distressed assets in the economy, potentially slowing down the cleanup of bad credit from troubled sectors like commercial real estate. And if this starts to metastasize, watch high-yield credit spreads and cross-border capital flows for early signs of a broader flight to safety, and with it, tighter financial conditions. Another key focal point to watch is the regulatory response. This case highlights a potential blind spot. After the 2023 crisis, supervisors were intensely focused on systemic risks like interest rate exposure, but they may have underestimated how an isolated, old-fashioned fraud case can still trigger market-wide contagion. This may force regulators to broaden their stress test scenarios to include these kinds of operational risks, which would increase the compliance burden and costs for regional banks that are already facing significant headwinds. Speaking of financial system vulnerabilities, there's an equally puzzling contradiction playing out in the stock market. Amid chatter of bank failures, trade wars, and a potential AI bubble, the US stock market is still posting solid gains this year, with the S&P 500 up roughly 13%. That surprising resilience is exactly what has some of the biggest names in finance on edge. The top 5 tech names make up more than a quarter of the S&P 500. That concentration means resilience can flip to fragility fast if just one of those giants wobbles. While many on Wall Street are dismissing recent credit events, like issues in regional banks or rising defaults in subprime auto loans, as isolated or idiosyncratic problems, there's a growing concern they might be the first cracks in the system. With interest rates staying higher for longer, weaker borrowers are the first to feel the pressure. If these isolated incidents start becoming a trend, it could signal a major turn in the credit cycle, leading banks to tighten lending standards for everyone and potentially triggering a broader economic slowdown. We should keep a close eye on the Federal Reserve Senior Loan Officer Opinion Survey, or SLOOS, which acts as a leading indicator of whether banks are becoming more cautious. Rising auto delinquencies and corporate default rates were already on our watch list, warnings that some bank CEOs echoed even during strong earnings. So any deterioration there would rhyme with this tightening story. The Bank of England just issued a stark warning about, quote, stretched valuations and the rising risk of a sharp market correction. And they're not alone. The International Monetary Fund declared in its latest report that, quote, markets appear complacent as the ground shifts, pointing to geopolitical uncertainty and rising sovereign debt. Much of this market complacency is built on a simple belief, the Fed put. This is the idea that if the stock market falls too far, the Federal Reserve will always step in to save the day by cutting interest rates. It's been a reliable safety net for investors for decades. Now, get this. With inflation still stubbornly high, the Fed's hands may be tied. Any hawkish surprise from the Fed, a signal that they are more worried about inflation than a market dip, could instantly invalidate the main reason for the market's optimism and trigger that sharp correction everyone is talking about. Markets were leaning on a smooth easing path. Sticky inflation keeps that path narrower than many would like to believe. We're seeing unstoppable enthusiasm for AI driving corporate profits, while at the same time share prices that, when measured against standard metrics, are historically very high. When we say valuations are high, we're often looking at the forward price to earnings, or PE ratio. Right now, The S&P 500's forward PE ratio is around 24, while its long-term historical average is closer to 15 or 16. This means investors are paying a significant premium betting on a massive boom in future earnings that is yet to actually materialize. Because the index is so top-heavy, those elevated multiples are being set by a handful of mega caps, amplifying the market's sensitivity to any change in their guidance. Some analysts are now openly questioning how the vast sums of money being poured into AI will ultimately pay off. The current AI rally is very different from the dot-com bubble. This time, the investment is concentrated in a few profitable mega cap tech companies like Microsoft, Alphabet, and Amazon. This makes the entire market incredibly sensitive to their spending plans. These companies are projected to spend nearly $185 billion on capital expenditures or capital expenditure next year, mostly on AI data centers. A slowdown in this spending by even one of these giants could send a shockwave through the market, making everyone question if the AI productivity boom is real. Capital expenditure growth at some hyperscalers had already decelerated versus expectations, and trade threats could prompt a pause, putting knock-on pressure on suppliers like Nvidia. We even walked through a single session when mega caps collectively lost hundreds of billions in market value, a reminder of how quickly sentiment can flip when that spending narrative is in doubt. For Chinese audiences, it's also worth noting that geopolitical tensions, especially in the tech sector, add another layer of risk that may not be fully priced into stocks, particularly for industries with complex global supply chains like semiconductors. AI-related trade has been a key engine for global growth, much of it centered in Asia, so any strain there tests how complete de-risking really is. Of course, many investors remain bullish. Firms like Goldman Sachs and Wells Fargo have boosted their year-end forecasts, betting on solid US growth and the prospect of falling borrowing costs. UBS Global Wealth Management, for its part, sees the S&P 500 climbing another 4% by the end of the year. But this rally has been called unloved by market veterans. As one chief investment strategist at CFRA Research put it, it's just a matter of time. Quote, corrections and bear markets have not been repealed. They might simply be delayed. So what's next? The key things to watch are, first, the quarterly capital expenditure reports from the big tech companies. Any sign of a slowdown is a major red flag. Second, watch inflation data and the Fed's language very closely for any hints that the Fed put is off the table. And third, keep an eye on those credit quality reports like the SLOOS to see if the small cracks are getting wider. If geopolitics heats up, a sustained rise in the VIX would tell you markets are finally pricing that risk, and a rollover in non-residential fixed investment would challenge the capital expenditure shield narrative. This information is for informational purposes only and does not constitute investment advice. All financial market data is subject to rapid change. We were just talking about market vulnerabilities. Now, let's shift our focus to a political move that's creating its own kind of economic disruption. A drug that can cost $1,300 a month could be slashed to just $150. That's not a typo. That's the new price target for weight loss drugs like Ozempic, announced by former President Donald Trump, and it's sending shockwaves through the pharmaceutical industry. During a recent event, Trump stated directly, quote, instead of $1,300, you'll be paying about $150. The fallout on Wall Street was immediate and severe. Shares of the two titans in the weight loss drug space, Eli Lilly and Novo Nordisk, tumbled, closing down 2% and 3% respectively, billions in market value, gone in a flash. Believe it or not, an aggressive price cut on a blockbuster drug category like this could create a significant one-off shock to national inflation data. A 90% price drop would pull down the medical care component of the Consumer Price Index, or CPI. This could complicate the Federal Reserve's job by introducing a large administrative price drop that might mask underlying inflation trends in the rest of the service economy. It's a potential curveball for economic policy. This is where the situation takes a more complex turn. Just as the statement was made, Centers for Medicare and Medicaid Administrator Dr. Mehmet stepped in to clarify, quote, we have not negotiated those yet, revealing a dramatic high-stakes negotiation is still very much in play. This isn't a done deal. It's the opening shot in a pricing war. And the collateral damage is already spreading. The biggest loser of the day wasn't a pharma giant, but Hims and Hers Health, a telehealth company that sells cheaper, compounded versions of these drugs. Its stock plunged more than 15%. Why? To understand this collapse, you need to know what compounded drugs are. These are essentially custom mixed versions of medications prepared by specific pharmacies. But here's the catch. They are not FDA approved, meaning their safety and efficacy haven't been verified by regulators. The entire business model for companies like Hims and Hers is built on what's called price arbitrage. They thrive in the gap between the very high price of the official brand name drug and the much lower cost of their compounded alternative. A government enforced price cap that brings the official drug down to $150 doesn't just narrow this gap, it completely erases their business model. This is a classic example of extreme regulatory risk, and it's sending a chill through the entire digital health sector. A $150 price for official brand name drugs like Zepbound and Wegovy wouldn't just be a discount, it would make them cheaper than the alternative market that has exploded to meet consumer demand. This is part of a larger administration push to align US drug prices with what other countries pay, a move that companies like Pfizer and AstraZeneca have already signed on to for other drugs. This approach is often called a most favoured nation pricing model. It directs the government to set pricing targets, ensuring that Americans don't pay more for medicine than patients in other comparable developed nations. The benchmark is often the lowest price found in a group of countries within the OECD. It directly threatens the high-margin US market, which has traditionally funded a huge portion of global research and development for pharmaceutical giants. For a European company like Novo Nordisk, this could trigger not just investment disputes, but a strategic rethink of where they invest in future R&D. The message is now crystal clear. The administration is targeting the immense profitability of GLP-1 drugs, and the ripple effects are threatening to upend the entire market, from the largest pharmaceutical companies to the smaller players who thrived in their shadow. That reminds me, there's another potential long-term effect to watch. If these powerful drugs become truly affordable and widespread, some economists believe it could function as a positive labour supply shock. Studies have consistently shown that obesity-related health issues result in significant economic costs from increased absenteeism and lower productivity at work. Widespread, affordable treatment could, over time, boost labour force participation and productivity. This could actually raise the economy's non-inflationary speed limit, giving the Federal Reserve more flexibility in its policy decisions. So the key focal points to watch now are not just the stock prices, but also the progress of these price negotiations and any updates to the CPI's medical care data. As always, all market data is subject to change in a volatile environment.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.